world's latest corporate accounting scandal comes out of Germany, involving a payments company called Wirecard, who also owns subsidiaries in the US. Shares in the company plunged 20%, following reports that at least two of its Munich-based executives knew of alleged accounting fraud, namely book padding, that has apparently been going on. They deny the allegations. Supplanting Commerzbank in Germany's DAX index last year, Wirecard are now a major player in the online payments industry. Founded in 1999, they initially provided services to online gambling websites and barely survived the dot-com crash. However, Wirecard have now grown to such an extent that they are threatening traditional banks and until recently were worth more than Deutsche Bank, Germany's largest lender. It is not the first time the company has had to defend its accounting practices. Their shares dropped after past claims were published about accounting irregularities in 2008 and later fraud allegations in 2016. Authorities in Singapore are currently looking further into the latest allegations, being the site of the alleged round-tripping scheme that was part of the pattern of supposed book padding across the company's Asian operations. They are not the only ones who have been hitting the news recently over their accounting irregularities. Patisserie Valerie, a much-loved British chain of cake shops, has recently been brought down by the fraudulent accounting practices of its finance director. An investigation found some very serious manipulation of both the balance sheet and the profit and loss accounts. Questions are obviously being asked as to how no one else noticed what was going on. History shows us that accounting scandals are not a black swan event. Arthur Andersen, formerly one of the world's top 5 accounting firms, were found guilty in both the Enron and waste management company scandals. It's no surprise, therefore, that they are no longer in business. It's not always the accountants at fault, of course. In 2002, following the WorldCom scandal, masterminded by the company's CEO, Bernie Ebbers, Congress passed the Sarbanes-Oxley Act, introducing the most sweeping set of business regulations since the 1930s. In the same year, the SEC uncovered the Tyco scandal, which had been orchestrated by its CEO and CFO, who had siphoned money out of the company in the form of unapproved loans and fraudulent stock sales. Let's not forget the Freddie Mac scandal, involving the company's COO, CEO and CFO, who intentionally misstated earnings. An SEC investigation resulted in a $125 million worth of fines and the firing of all 3 of them. AIG managed to survive a $3.9 billion accounting fraud in 2005, when CEO Hank Greenberg allegedly booked loans as revenue, steered clients to insurers with whom they had payoff agreements, and told traders to inflate stock prices. Lehman Brothers were alleged to have hidden over $50 billion in loans disguised as sales. In 2008, they famously went bankrupt. The same year, Bernie Madoff, aided by his accountant, tricked investors out of billions of dollars in the largest Ponzi scheme in history. The lessons are clearly out there for all to see, but time and again, for whatever reason, maybe greed, maybe panic, accounting frauds just keep on coming.